Good morning and welcome back to Almus Market Mornings. From the geopolitical angle, the major anxiety remains whether the Red Sea route will get disrupted. There are some reports indicating Saudi's exports via this route has already been impacted. For energy markets, in the end, the actual flows will drive up the prices. Oil continues to edge up. Yields are higher too. And speaking of yields, dollar index has moved higher, especially on the back of yen weakness, which has already crossed 163 against the dollar. President Trump also announced a 100% tariff on generic drugs imported into the US starting August 2028, post which this levy would rise to 200% starting the next year. Let's understand all this from JK. Morning, sir. So, couple of things. Does the tariff impact our own pharma exports to the US? And what's your take on the yen move?
Yeah, good morning, Swaraj. Yes, this tariff on pharma generic drugs, uh, it's going to be like 0% till July 28 and 100% 1 year after, 200% 2 years later. Now, according to the statement by Trump in Truth Social, the time of 2 years is given to pharma companies globally to relocate generic drug production to United States, and the companies that fail to establish their manufacturing capacity in the US would face steep tariffs. Now, for to me, this looks a bit irrelevant because 2 years time, Trump would be leaving office, and we don't know how the new president or incumbent would be dealing with the tariffs itself. So right now, it's for the companies no, probably to plan whether they really want to invest in the US for production of generic drugs. But that apart, when we spoke about the global markets facing many challenges as we entered this week on Monday's update, we were also seeing the markets are facing quite a few headwinds because the conflict was escalating. Tech stocks were looking vulnerable and yields were rising. And these challenges have continued to worsen, except that tech stocks have got some relief from earnings reports and perhaps consolidating a bit more. And they remain volatile, of course. But to this, we have now added to this list. We have now added another headwind, that is a trade war. Trump imposed 50% tariff on various goods from Canada for their discriminatory treatment to American goods, and then these generic drugs, which is of course a long shot that they are taking out. Then there has been a bipartisan move by legislators in US to impose 100% tariff on countries importing oil from Russia. Again, this is not implemented; is on the cards. Then yesterday, U.S. Trade Representative Jamieson also said that the tariff of 20 to 12.5%, which they had imposed as a temporary measure, will expire later this week. But Trump administration is exploring new tariff measures targeting dozens of countries that could be announced soon. So tariff is again started to haunt the markets, and although of immediate concern to global markets is the conflict that is intensifying. It has broadened beyond the Strait of Hormuz, with the Houthi allies effectively opening a second maritime front, in the Red Sea. Two of the Saudi crude tankers bound for China and India reportedly reversed course after implementation of the naval blockade against Saudi Arabia. And President Trump has warned that there will be a strong response if Red Sea route is blocked. And of course, giving momentum from getting momentum from all these crude prices have moved up. Brent has crossed 92 again. A good sharp move yesterday that was seen. And what I'm seeing also is that for some time now, market had played the short side of the crude, particularly after the MOU was signed between Europe, US, and Iran. But they have not only squared up, but they are now playing the long side as well. So the momentum is with the oil prices, and many people again start talking about 100 being crossed and all that. So the headwind for the market have only increased as we moved along during the week. In fact, I've heard at least two influential voices pointing to big risks ahead. Warren Buffett recently pointed to trouble ahead for the markets, even as Berkshire Hathaway continues to reduce their shareholding and increase the cash holding, actually. Jamie Dimon of JPM yesterday said investors are underestimating the risk facing global economy and pointing to high valuation in both stocks and bonds. markets, are at a stage when these influential voices will definitely carry a lot of, weight. So we are seeing, particularly in the bond market, we are seeing good move up in tenors across 2 year is at 2.5 year high. And of course, the 10-month and 10 year and 30 year are also at nearing the recent highs. Now, the story that's also catching focus of big players in the market, on the bond market, is Fed has been funding themselves to honor the maturing long-term bonds through short-term treasuries, that is 1 year up to 2 years. But in the next 1 year, as much as 2 trillion is maturing for rollover, and add to it the elevated interest cost that they have to pay as well. And foreign demand for US securities is falling, and the major domestic players are also demanding higher premiums. So I can see real turmoil up in the bond market. So if you look at it, after the MOU was signed, when the oil prices fell, the reaction in the bond market to the upside, or rather the yields to the downside, was very limited, and we are now back at the highs. So it's very clear, bond market is going to pose a major headache to the market, and that will probably impact all other markets as well, including the stocks. And the stocks are already overvalued. Now, that is where I'm seeing that, markets have now really started to reduce their exposure, not only to the high valued stocks, but also to the bond market. That's where the precious metals yesterday have actually started to move up, and gold and silver both have seen a technical breakout of the downtrend that was seen for quite some time now. I'm not saying it's a full reversal to the upside, but at least for now, we are seeing a good buyback into gold and silver by the market. And I think it definitely makes sense to get into these metals, as a alternative now, because now that they are also at good bargaining levels compared to the levels that we have seen in the last 1 year. Dollar, which was retracing back towards 100, not exactly 100, but then 100.5 was seen, the breakout level. But it has reversed course quite swiftly, with oil rising and trades well above 101 now. Importantly, yen trades above 163, which is a new 40-year high for the dollar. And the Japanese authorities seem to have given up, at least for now, about intervention. And while most of the developments, be it oil or bonds, are hugely negative for the dollar, in the medium term, near term, definitely dollar is supported due to safe haven buying. Dollar rupee had a one-off calm day yesterday. A lot of selling was seen, lately some triggered by offshore points coming off, and also some positive influence from the RBI data on capital flows that was seen since they showed announced measures in June. FCNR garnering as much as 17 billion, and including other flows about 20 billion. So market again started to reassess, like, we have another 2 months to go, more than 2 months to go for these schemes to run, and might well see much larger flows. Still, we had to wait and see, of course, because the yields going up in the US also might pose a problem towards that. But at least for yesterday, there was a pause, and then even FIs were buying Indian stocks as well. So some sort of a relief day for the market in India. But I don't think it stays too long, because oil crossing 90 and then, threatening to go towards 100 is again a big problem. And I have to repeat again that, we are not in the same position as we were in April or May, because we have used up, the world has used up the strategic petroleum reserves. And if the shortages come through because of closing both the sea routes, then it's going to be a big headache for markets, particularly oil importing countries. And if you look at Japan, for example, they've actually increased the subsidy for oil for the retailers, which means they are getting more and more conscious of the higher oil price. One of the reasons why yen has also weakened. So all in all, I think currently things are not looking so great for the emerging markets, particularly those dependent on imported oil. And dollar seems to be gaining ground once again. I think the rupee will be again feeling some heat for some more time. 96.50, of course, is the line in the sand. If we do break, then market will start focusing on 97. But we'll see what the central bank does in this. Thank you.
Thank you, JK. And yes, one-off day yesterday for Rupee, we saw a bit of a positive sentiment, some appreciating bias, but overall, if let's say the oil goes haywire, we might be in a lot of trouble. We have reiterated this even yesterday. So let's see how all that plays out. We are also seeing globally dollar index strengthen. There was somewhat of retracement in the past few days, but again, we have seen this reversal quite swiftly. Dollar JPY, importantly, trades above 163. So all those intervention talk as of now seems to have a moderated. And of course, markets are looking at geopolitics. Though it seems the conflict has broadened beyond the Strait of Hormuz, it's now at Red Sea as well. Two tankers who were en route to China and India, they have turned back due to the blockade. That's the update we have received. And of course, with the tariff things are already on the edge. So yeah, a lot of narratives to look out for. And of course, there's always the concern of whether the AI related stock valuations, they are bloated or not. So, you have one more element that keeps markets nervous. So we keep tracking all these narratives. But that's it from us today. Thank you for listening. We will catch up tomorrow with a fresh round of updates.